Krystal, what are you taking a look at?
Well, now that we are a few days out from the Silicon Valley bailout, I've had some time to reflect on some of the deeper problems in the banking sector and in our economy that has led us to this place of frequent crises, crashes, and bailouts requiring ever-escalating dramatic interventions. And all roads seem to lead back to one place, the Fed. Whether you look at the micro causes of this bank failure, the details of this bailout, or you zoom out to look at how we ended up in Gilded Age Part 2 here, the Fed's choices are at the center of these stories. Now, the TLDR is this. Over the course of 4 presidents and 2 decades, the Fed has claimed extraordinary powers and then chosen to use them only on behalf of the wealthy and well-connected. First, let's start with the specifics of this particular crisis. Silicon Valley Bank leadership deserves all the shame and blame in the world. But greed and idiocy are a permanent feature of human societies, which is exactly why we build safeguards into systems to protect blameless people from the greed and idiocy of others. So where the hell was the Fed while Silicon Valley was loading up on uninsured deposits from a group of clients under severe pressure from the Fed's own interest rate moves, while also loading up with long-term treasuries subject to the exact same risk? This crisis was entirely predictable and was in fact predicted by at least one short seller who has been posting about it on Twitter for months. Making matters worse is the fact that Silicon Valley Bank CEO actually sat on the board of the San Francisco Fed. Not exactly a great look. The Fed was asleep at the switch, failing at one of their most essential tasks. What's more, Lever News is reporting that the Fed actually gave SVB a special waiver in 2017 that allowed them to double dip as both a traditional deposit-taking bank with a huge venture-backed clientele and also an investor in the very venture capital funds which were backing their clients. This left the bank doubly exposed to the tech winter, which has crushed startup valuations, dried up funding, and led to mass layoffs in large tech companies. So if the Fed can't be trusted in their role as regulator, what can they do well? Well, the dual missions of the Fed's monetary policy are supposed to be unemployment and inflation. And of course, the Fed has made a big show of dramatic interest rate spikes in order to try to curb inflation. Their explicit goal with these actions are to crush labor, spike unemployment, and lower wages under the theory that this will help to get inflation under control. Now, let's put the sociopathy of this policy aside and just ask, how's that going? Well, as some of us predicted, doesn't really appear to be working well at all. We've got new numbers on inflation, and they ain't great. The top-line annual numbers showed some improvement, but under the surface, the news was all uniformly bad. The core consumer price index jumped 0.5% month over month. That was the fastest acceleration since September. In other words, the medicine is not working, but it could very well be killing the patient. Elizabeth Warren has been warning of exactly this scenario for some time now, notably last week in a pretty hot exchange with Fed Chair Jerome Powell. Take a listen.
In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation. And we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
And you know what, Chair Powell, to be fair, he's got a point. Inflation does hurt workers. The Fed does have a limited set of tools to deal with it. There is no substitute for having a functioning legislative branch that is more appropriate for dealing with the supply chain, war, price gouging, and climate crises related price increases that are at the core of this persistent inflation. But The current bailout response really exposes the game that the Fed is playing here, because for them, as explained by Jerome Powell there, ordinary workers getting hurt, well, that's just unintended consequences, necessary pain. But everything that hurts rich people is deemed an emergency. They interpret their powers in an extraordinarily broad way when it comes to helping the wealthy and the well-connected, yet they throw up their hands when it comes to helping anyone else. Remember, one of the primary political justifications offered for this new bailout, which has created as a de facto policy that 100% of every rich person's deposits are backed by us, dear taxpayer, and that every bank is now too big to fail, was that workers in Silicon Valley might lose their jobs. Now, I am sympathetic to those concerns. I genuinely am. Losing a job can be traumatic, devastating, and in some instances, even life-ending. But why does the Fed care so much about these particular workers, yet have such a blasé, callous regard for the millions of workers that their rate policy is explicitly engineered to toss out of a job? The details of this bailout go even deeper, though. Allow me to get a little bit wonky here for a moment to try to explain a key point. In crafting its response, the Fed invoked its power under Section 13.3 of the Federal Reserve Act. As explained by Nathan Tankis in his Substack Notes on the Crises, he notes that Section 13.3 requires an emergency, or what in the law they describe as, quote, unusual and exigent circumstances. Now, an emergency is, of course, all in the eyes of the beholder. The Fed clearly thinks rich VCs having to provide a bridge loan to their portfolio companies is an emergency, but the aforementioned millions of people losing jobs because of Fed policy is not an emergency. As Tankis writes, if this is an emergency, then basically any moderately sized event with a knock-on effect on the economy is an emergency. Unusual and exigent circumstances seem now to be little more than a day where there was moderately bad weather. Or at least, I would add, moderately bad weather for the bankers and investors that the Fed is deeply connected to and apparently very persuaded by. The fundamental problem is this. Congress is dysfunctional and corrupt, so our fates are all subject to the whims of courts and of the Fed. As one person on Twitter said, roughly speaking, the current definition of democracy is ruled by judges and central bankers. We desperately need a working, actual democracy. But hey, at least if we're going to be ruled by powerful, undemocratic institutions, they could cut us in on the deal here. Ryan Cooper at the American Prospect floats one good potential idea with regards to the Fed. He says a banking public option, it's a pretty simple concept. Right now, only banks can have accounts with the Fed. What if everyone could? Now, the benefits would be immense to ordinary people. Every American could have a free basic checking account, zero fees, zero transaction costs. Transfers between these accounts would also be free and quick. Any government stimulus programs like the previous stimmy checks, they could be easily deposited instantaneously. And critically, by cutting out the rapacious banking middlemen, citizens could immediately benefit from higher interest rate earnings on their accounts when the Fed does lift rates. Right now, when the Fed lifts rates, banks basically do nothing. They keep savings account interest near zero. With a Fed account, you would instantly benefit from the increase, thus ending a massive Fed subsidy that banks currently benefit from. Unfortunately, when the Fed asks their other banker friends about this idea, I'm sure they're going to argue it's terrible, it's disastrous, forget about it. They'll continue crafting policies that are of the rich, by the rich, and for the rich. Only massive public pressure of the sort that made Powell and the rest feel their power was at risk would make them change course. Otherwise, we will just continue to lock in a two-tier system. Rich people's minor problems are an emergency. Regular people's actual catastrophes, those are just collateral damage. A lot has been revealed here, Sagar, about the Fed's act. Hey guys, ready or not, 2024 is fully upon us now, and Sagar and I have been brainstorming ways that we can really up our game for this critical election.
Yeah, we rely on our premium subs to expand our coverage, to add staff, to upgrade the studio. We just want to give you the best independent coverage of this election, which is possible. So if you can help us out, become a premium subscriber today, breakingpoints.com, or the link is down here in the description video. It really means the world to us, and if you like what we're all about, this is the best possible way to keep us 100% independent, working only for you.